Hello, welcome to this evening's webinar about cash value private banks. My name is Steve Rideout. I'm the founder and president of Cash Value Private Bank, and I'm going to expose you tonight to the benefits of a cash value private bank. Cash value private banks are vehicles, asset vehicles that most people don't even know exist. Which is amazing considering, every major company and every major bank themselves have a lot invested into their own cash value private banks. Wells Fargo, for example, has $19.4 billion in cash value private banks, but most people don't know they can build their own cash value private bank. And tonight, you're going to learn how they work and the benefits of having one. Now, I have a 45-year career in complex derivative finance, arbitrage, and portfolio construction. And I'm going to share with you, whenever possible, some of the things I've learned over that time. So maybe you can understand why when I sold a company in 2015 and went looking for some place to put my money, to protect my money and to grow my money, I found cash value private banks. I was startled. I wish they would have been around when I was younger. They're perfect vehicles for somebody who's 30 to 50 to start building their money because they're a compound vehicle. And compounding takes time. Now, if you're older, under 70, and you have a chunk of money that you can ramp up the bank with quickly, then you can also achieve some compounding effects that are beneficial. But a cash value private bank is not a get-rich-quick scheme. It takes a while for it to get going. But again, risk-free, tax-free growth over that time and for the rest of your life every day. So let me go into some of the benefits, but first let me tell you a little bit about my background. I arbitraged building materials between the U.S. mainland and Hawaii starting in 1978. I would go to the Pacific Northwest. I would put everything I needed for a house into 2 containers, down to the rope hooks on the bathroom doors, ship them to the lot. And the first time I did that, I got them to the lot for $25,000. This is 1978, remember? Different dollars in that time. And if I would have purchased them from local suppliers, piecemeal, the way you had to do when you had to get a loan from the bank, I would have paid over $100,000. I got them to the lot for $25,000. I sold them within a week for $50,000. The person who bought them for $50,000 got them at half the price they would have had to pay, and I doubled my money. So I thought, this is a good business, this arbitrage business. Arbitrage is finding something that has value in 2 different places at the same time, 2 different values. So I helped build the world's largest cash energy brokerage. I arbitraged $5 billion per month of energy, domestic and international, and built the first worldwide grade and location arbitrage program connecting New York, London, Houston, and Tokyo. And I managed that operation in Europe out of London until 1992. That was really an interesting program because back in 1985, it was just a simple Excel spreadsheet, the very first ones, but it was like magic for us. You could calculate values on the opposite sides of exchange rates. It was wonderful. I deconstructed utility portfolios and helped build risk management operations in 2 Tier 1 utilities in the U.S. And at the same time, I founded and managed a scientific institute of 16 physicists, engineers, and other scientists developing new applications of modern physics to asset pricing. We published 2 seminal works on option pricing and relative values, and one of those works is in use today in every major corporation and bank. Any entity that has to value assets on opposite sides of an exchange rate uses this product that we built. I was the chief operating officer of fund of hedge funds with $450 million allocated out to quantitative managers with diversified proprietary return streams. I co-founded and was the chief operating officer of Helios Scientific, commercializing a new type of chemical reactor that produces renewable biochemicals from biomass that replace petroleum-based chemicals. This technology is changing the world, and I believe, as do all of my mates who are working on the project, that this technology is going to have a greater impact on the world and reducing the problems of climate change than any other technology, far more than anything electrical. Electric cars, sure, it's great, but you can't make chemicals out of electricity. The only way to make chemicals is to make chemicals, and electricity is not a chemical maker. So you can drive a car with electricity, you can heat a house, you can do things with it, but you can't replace all of the products. Look around your office, your bike, whatever you want. You can't replace those actual physical things without being able to make chemicals. And we're the only technology that can make these chemicals from renewable products at a reasonable price. I'm now the co-founder and chief operating officer of a company that's a technology holding company. So if any of you are interested in what's happening with this technology, we just signed a contract this week to provide sugars from renewable products, biomass, to make jet fuel. And hopefully that's going to be, a major change in transportation because, electricity, you can't fly a plane on electricity. It takes fuel, and we're the only ones who can make that at a good price. So if you want to know more about that, let me know. Back to cash value private banks. Well, they can be a savings vehicle. They can be an alternative to bank savings accounts and treasury paper. And with low interest rates, they produce over a 30-year period right now 600% higher return than a treasury paper or a savings account. Now, they're immediately liquid and they're actuarially based bonds. So instead of being tied to financial markets that are moving around, this is tied to people, their age, their health, and actuarial tables that are based around that. Now, as an investment, Cash Value Private Bank itself is an investment vehicle. Your wealth grows tax-free and risk-free, guaranteed for life with no exposure to market volatility. We're going to go into that in detail. And you can use your Cash Value Private Bank as collateral for an immediate, no questions asked, tax-free loan. And you can use the estate value that's created when you start your bank for commercial loans and outside projects as well. We're going to go into the borrowing aspect because that leads to describing how you can use your cash value private bank as an arbitrage vehicle, compounding your cash values against outside investments and compounding them against internal simple loan interest, where your wealth simultaneously works in two places at the same time. As far as protection goes, the counterparty risk mitigation that is provided by a cash value private bank is unequaled. There's something called a risk-free rate of return. Essentially, it's the benefit gained by buying U.S. government treasury paper. So the return you get from buying treasury paper is considered risk-free because the counterparty, the government, is not likely to default on that product. But the insurance companies that we use to build cash value private banks have been paying dividends for over 160, 170 years and have never missed a year through the Great Depression, through all the world wars. These are the most stable counterparties there are. And because their entire business is siloed, if you will, in these actuarial-based tables, they're just stable and outside of the world of debt, outside of the world of markets and fluctuations. So now risk management, all of these factors, guarantees, arbitrage, risk-free diversification, these are all options that can be used to offset risk, as well as what we just talked about, this counterparty risk mitigation. These are major assets and benefits to a cash value private bank. As an estate build, there's an immediate estate created as soon as you open your bank, and that estate can be used as collateral to secure commercial loans and for other outside purposes. The ideal underpinning of the cash value private bank is the guaranteed and reliable growth and legacy appreciation that it provides. So now, what is a cash value private bank? Well, it's a unique and sophisticated portfolio of risk-managed derivative insurance products. They're actuarially based versus market-based in their design. And no two private banks are the same. Each one, just like each person, is unique. You build the bank to achieve the goals that you want to achieve. It's your bank, it's private, and it's achieving what you want to achieve. So even though Cash Value Private Bank employs derivative insurance assets, it is not life insurance as it is commonly known. It's built on a life insurance chassis. As you'll see, though, it combines assets in a way that have not been combined before. Typical old life insurance is purchased to provide a death benefit. A cash value private bank is designed to provide life benefits. For example, tax-free and risk-free guaranteed wealth growth, penalty-free access to liquid cash for emergencies and alternative investments, creation of an immediate estate that can be used as collateral for loans and purchases, and post-retirement income or life legacy. Now, the insurance business is one of the oldest and most stable industries there is. In the 1600s in England, there were friendly associations. That's when Lloyd's of London started. By 1730, insurance companies were in the New World. They insured cargo and property. By 1810, people realized that value, wealth, didn't just accumulate by itself. It was accumulated around people. And they called that the human life value. And all of a sudden, people realized, hey, if I'm going to insure my cargo, my property, I should insure myself. I'm the one who brings this cargo together. And that's how life insurance started. By 1840s, life insurance companies were paying the first dividend. And dividends have been paid every year for over 160 years with a small handful of mutual insurance companies. Between 1940 and 1970, whole life with cash values was popular. And if it wasn't for the cash value in Walt Disney's whole life policy, Disneyland would never have been built. Commercial banks didn't want to give him loans for the idea that they thought was crazy. So he took a loan out of his cash value private bank, even though it was not an efficient bank at the time. He took a loan out of the cash value and started Disneyland. Now, by the 1970s, financial options came about, puts and calls. These are insurance policies. They're just insurance policies that aren't written by insurance companies. They can be written by any individual. You, me, anybody can buy and sell a put or a call in financial markets. But they're insurance products just the same. Consider that if you get car insurance, it's protecting you against an occurrence. Something negative happens, you get in an accident. Well, a financial option protects the person who buys it from an occurrence in financial markets if the market goes above or below a certain price. Now, we're not going to use financial options in a cash value private bank. The reason I bring them up and here is for people to understand that these insurance products change the nature of risk management, change the nature of financial markets worldwide in the 70s. By 1982, the idea of qualified retirement plans came to be, and term life became popular. Qualified retirement plans like 401ks and IRAs, people realized, and Wall Street sold, the idea that because term life is less expensive than whole life, you could buy term life instead of whole life and put the difference into a 401k or an IRA or the markets in general. With the idea being that you would make enough money from the market investment to outpace the death benefit that would come from whole life. It's not true, and this industry, the qualified retirement plan industry, is being seen for what it is. It's a falseness, but the point is that whole life, because it's guaranteed to pay out a death benefit when you die, whenever you die, and term life doesn't pay out a death benefit unless you die over a specific term, and there's only 1% chance that during that term you're going to pass away. Term life is less expensive, and whole life is more expensive. So we're going to talk about those two things again a lot more in just a minute. In 1990, a person who owned forests realized that the 30 years it took for his forest to grow had very similar characteristics to the 30-year period that a cash value grew inside a whole life policy. And this is the person who started building his own cash value private banks. Again, they weren't horribly efficient then, but because he had the 30-year time frame with the asset that he already owned, it was a perfect hedge for him. By the year 2000, people had caught on to this long-term compounding effect of a cash value inside an insurance policy, and insurance companies came up with new riders to enhance the private bank structures. And now you could build a cash value private bank in a way that you couldn't before. So while the elements of a whole life cash value private bank have been in place for 80 years, it's really only been the last 15 years that you could optimally build a cash value private bank. And the way you would do that, and what we're going to look at now, are whole life cash value whole life policies, term life, dividends, and these new riders. Now, in a typical life insurance, one chooses between term life or whole life. Nobody buys both, they buy one or the other. But in a cash value private bank, we combine term life and whole life, and there's no other insurance product that does this. We'll show you why this is in a minute, but just quickly to tell you that if you were buying a death benefit in whole life, it would cost you more because that death benefit would be guaranteed to be paid out as long as your policy was funded. If you're buying death benefit in term life, it's not likely they're going to have to pay the death benefit because the term life policy is going to expire before you get to the point where most people get to the point where they pass away. So now, term life has no cash value. It only goes for the period of time that it's purchased for, 20, 30 years. And while term life is less expensive in the beginning than whole life, it's way more expensive after the first term runs out. If you were buying term life for your whole life, you would pay way, way more than if you just purchased a whole life policy. But it's the death benefit price that we're going to be talking about more, that the term life buys a death benefit at a lower price. The whole life has a chassis that's underlaid by a cash value, and the term life and whole life combined gives you a cash value, whole life, a death benefit that's built on both term life and whole life that's purchased at a very low cost. Now then we add a third derivative element, a paid-up additions rider. This allows the owner of a cash value private bank to fund their bank with a high cash value capacity. Now, a cash value private bank has two forms of income. Guaranteed interest payments every year, notice that word guaranteed, and if the carrier is a mutual insurance company, and that's the only people we build these with, then a net dividend payment is made every year as well. Now, these income payments are made as a percentage of the cash value, which is why having a large cash value capacity is so important, and why a cash value private bank is so different than a typical old life insurance policy. Old whole life has a fixed death benefit and a small cash value. You can see in year 1, the death benefit is the same as it was in year 30. In year 1, the small cash value has grown a bit, but not by much. Now, in a cash value private bank, there's a growing death benefit and a large and growing cash value. You can see the death benefit starts a lot higher, and this is for the same amount of premium. So the same premium that's buying the old whole life and buying the cash value private bank, look what you're getting in a cash value private bank. You're getting a huge death benefit, and you're getting a huge cash value right from the beginning. And over the course of time, putting in the same premium, you are going to get a much bigger death benefit and a much larger cash value after 30 years. Now, old whole life has inflexible premium values. Flexible premium values are in your control in a cash value private bank. You're going to see that you can actually, because of the way the bank grows, you can have your cash value private bank fund your entire bank from inside using premiums. Now, cash value private banks are the only asset class that are tax-free and risk-free. But what does this mean? Well, the wealth you place in your cash value private bank compounds for your entire life. You get the guaranteed interest payments, and you get the dividends, and it all comes to your cash value private bank tax-free, as long as the bank is properly funded. And again, that's easy to do because after a short time, the bank can fund itself if that's what you choose. It impacts the amount of guaranteed compounding, but you don't have to fund it, and you can even build it so that it's only funded for a certain period. That's what they call period certain funding. And so you can build these banks in a variety of different ways to meet your needs and your goals. Now, you can remove and spend the dividends tax-free, and this is what you would do if you wanted the bank to fund itself. You would get the dividends that are paid and have them go back into the premium. But you don't want to do that if you don't have to. Why would you if you can leave your dividends inside the bank and have them compound? And at the same time, you can have access to all the money in your bank, even the compounded amount, tax-free. Now, if you remove the interest from your bank, it is taxable. But again, why would you do that? When you can leave it in your bank, let it compound, and you can access all of that money tax-free. You don't have to take your money out. You can leave it in there forever. You can access the money that's in your bank by using it as collateral for a loan to work outside the bank through an arbitrage or for a variety of other reasons that we'll see. Now, your estate is distributed to your beneficiaries after you pass on up to $25 million tax-free. So this is what we mean by tax-free. We don't mean tax-advantaged or tax-deferred. We mean tax-free if you just manage your bank the proper way, and all of that money, even it goes to your beneficiaries, again, up to $25 million tax-free. What do we mean by risk-free? Well, it's simple. The guaranteed interest payments and the dividend payments are not dependent upon any market. No matter what happens in stocks, bonds, gold, inflation, or any other market, your cash value private bank continues to compound market risk-free for your entire life. Now, what about counterparty risk? It's a great question. We only build cash value private banks with mutual insurance companies who have paid dividends for at least 100 years, and some of them over 170 years. These are among the strongest counterparties of any company in the world. Just think about it for a minute. Where does the money come from? It comes from a business that is completely separated from the rest of the world. It's based on age and health, and they silo this money in hundreds of different pockets, bucketed, that are defined by specific characteristics of age and health, and then they risk manage those, and that whatever and they risk manage them in a way that really is protective. This is where the dividends come from. After you sum up those hundreds of siloed categories, there's money that was not paid out, and that pays a dividend out. Now, a great question came up when meeting with somebody yesterday. They said, well, what happened during the pandemic? A lot more people died. It's true, they did die. But they didn't die in hundreds of different siloed buckets. They died in basically a single bucket, an age and, above 70, blah, blah, blah. That bucket probably was slightly on the distribution of its payouts a little higher than what was anticipated before the pandemic hit. But when you netted that out against all of the other silos, it didn't impact dividends at all. Not at all. And so we only build with counterparties who or mutual insurance company counterparties who have paid dividends for over 100 years through every business cycle, the Great Depression, every war, 2008 mortgage crisis. It doesn't matter. They've never missed a payment. Now, these dividends, anybody who has had a dividend stock, they know that you buy the stock, and as an owner of the stock, you get paid the dividend. But the owners of Cash Value Private Bank are an owner, a co-owner of the mutual insurance company. So being a co-owner of the mutual insurance company, we get the dividends. There's a tax-free dividend distributed to you every year. And again, we only build private banks with the oldest and most secure mutually owned insurance companies that have paid dividends every year for well over a century. Let's look at a case study of one Cash Value Private Bank. This private bank owner is a 35-year-old male. A female's Cash Value Private Bank would produce more earnings, and the reason for that is women live longer. Remember, all of this is based off of actuarial tables. So this person does not use tobacco, is in good health, is willing to make premium payments of $1,000 per month or $12,000 total per year, and is willing to put in a one-time additional payment of $10,000 at the beginning of the first year. So in the first year, at age 36, an immediate $563,859 estate is created. That's a 2,693% increase in usable wealth on the first day. Now, you can't access 563. You could only access what's in the cash value, which on the first year is 17,000. But that 563 can be used as collateral in commercial banks. And that makes all the difference. You want to buy a piece of property? You can use this estate value because the bank knows they're going to get $563,000 if you pass away. And so this can be used as collateral at a bank for a commercial loan from day one. Now, year 4, age 39, there's a 2.24% growth above the total premium. So what does that mean? You have $51,860 of cash value in your bank. The year before, it was $38,561. You see, you subtract those two, you find that $13,299 was the increase compounded in your cash value private bank that year. But you put $12,000 in, so you subtract that away. That means that $1,299 was the actual growth above what you put into your bank that year. You divide that by 58,000, which is the amount of total premium you put in, and you find that 2.24% of that $58,000 now was growing in your bank. And the bank grows every year from then on. And look what happens in 30 years. You put in $370,000 of premium, and you earned that year alone 10.45%. 10.45% on the total premium put in. And if you let that go, if you just kept compounding after 65, that number is going to grow. You can see over the 5-year period prior to the 30th year, 892 in year 25, 1045 in year 30. It's just going to continue to grow, as does the total premium. Now, you can stop paying the premium or reduce the premium any time you want. And you can literally stop putting premium in, let's say after the 6th year. We're going to look here at a second and see in year 6 that that's the point at which the total premium is less than the cash value. So from that point on, the bank owner can never have a capital loss. If they hit an emergency and they need to close their bank for any reason, they can do it without a capital loss, and that continues for the rest of their life. Now at year 30, age 65, there's an $813,000 net cash value that's accrued, and that is equal to a 4.83% tax-free and risk-free return every year for the 30 years. Even though it took you a couple of years to get the bank compounding, growing, it's like a business, starting any other business. It took a few years to get that compounding going, but by the 30th year, if you spread that out over the entire 30 years, the amount, the 813,017 minus the 370 equals a 4.83% return, tax-free and risk-free every year for 30 years. Now, what would an at-risk investment have to produce to equal a 4.83% tax-free return every year for 30 years? 4.83% in the tax-free cash value private bank is the same as 6.89% in at-risk markets, assuming 2% fees and 28% taxes, but not assuming any negative impact from sequence of returns. And this is something that very few people understand. We're going to go into sequence of returns here. But before I do that, I ask the question, is it likely that the markets will produce a 6.89% return every year for 30 years after sequence of returns? The answer is no, impossible. Now, a sequence of returns is versus the average annual return myth that Wall Street tells you. Wall Street says that if the markets are down 50% and up 50%, they're equal, that you're back to break even. But that's just not so. 50% down and 50% up is a 25% loss. Let me show you how. You start with $1, you lose 50%, and you only have 50 cents now working in the market. So when you get the next 50% profit, it only makes a quarter, because 50% of 50 cents is 25 cents. And now, even after a 50% down and a 50% gain, you're still down a quarter. You're still only at 75 cents. 50% down and 50% up is a 25% loss. And this problem is exponential. If you lose 10%, you must make 11% to get back to break even. If you lose 50%, you must make 100% to get back to break even. It took 16 years to recover from the Great Depression. We had to go through World War II and the Great Depression and everything else before people got back on their feet. 16 years. Now, the sequence of return on the 2008 mortgage crisis, well, from October 2007 to March 2008, the markets lost 57%. And it took 6 years to get back to break even. In 2010, Wall Street says you were back at break even, but you were still down 20%. At the true break even, 3 years later, Wall Street says you had a profit of 168% on a monthly basis. Well, if you bought the exact bottom and rode it there, that's true. On that low, from March 2008, you would have had a 168% profit. But if you took it from the October high, you would be back to break even at that time. Now, what lessons are learned from sequence of events? Well, sequence of returns negatively impact an investor's wealth. It takes a larger profit to get back to break even. No investor can capture the average annual return that Wall Street sells. All market investments are subject to the myth, and taxes and fees also have a negative impact. So if Wall Street tells you, the next time you hear somebody say that by investing in the S&P 500, you're going to get an 8% return over a certain period of time, think back to this presentation. They're lying to you. The average annual return they sell was 8%. But by the time you're done paying taxes, paying fees, and having the random luck of when you invested and the sequence of returns from that point on, you're going to be more like 1.5% to 3%. Now look at the rolling 10-year average annual returns of the S&P from 1939 to 2020, a 91-year period, 90-year period. There were 3 times when those average annual returns over the previous 10 years added up to 0. And that means that any time you were past the top and the market's heading down, you're losing money. So 3 times during the course of 30 years, the market produced no profit for the previous 10-year period, right? That's what sequence of returns is going to tell you when you start to find out that the impact of the sequence of returns and whether you're lucky to get in or not, impacts the revenue and the wealth that you generate. The other interesting thing to think of is right now we've had the longest bull market in history, been fueled by a massive amount of new debt, not fueled by productivity. The market produced, over the last 10 years, it produced an average annual return of 12.7%. The last 2 times you were at 12.7% return, within a 5-year period, the market fell and went down quickly, relatively quickly at least, to 0. So is this the time to buy the market? No. The time to buy the market was when it was at 0. Not now. Now it's time to do anything you can to stay out of the market and try to figure out how to get your money out of the market and get it into a safer investment. Because the question is, with the current massive government debt, personal debt, and political turmoil we face today, how likely is it that the economy is a bubble that will burst in the next 10 years? Well, this is probably the most important question we all face today from a finance standpoint. Ray Dalio, who is the billionaire who founded the largest hedge fund in the industry, Bridgewater Associates, says that these things come in 80-year debt cycles. From one new world order to another new world order. And ours started in 1945, add 80 years, and 2025 is when he's predicting. And now this is not precise. Could be 2028, it could be tomorrow. But he's predicting that this debt cycle will end during that period. And he's identified the telltale bubble signs that we see in the market today that suggest that this is true. We had a debt bubble. Okay, we had that. That's what burst in 2008. We have big wealth gaps. We have low interest rates. These are all things that happened before 1929 that led to the 1930s and the Great Depression. Then you're going to have a debt bust. We already had that. What happened this time in 2008? Instead of just letting the world kind of try to find its own balance, the Fed came in and started printing new money, 2009. That was the bottom of this massive bull market that we've had for 12 years. That debt bust then was followed by the printing of money and new credit. And these two things are already on the downhill slide of going to the 2025 New World Order. And at the same time, Ray Dalio says what happens are revolutions and wars. And anybody who's got their eyes open to what's happening politically and the malfeasance on all level of government at this moment has to be aware that we are in already a phase of revolution and war after printing money and after a debt bust. So what happens next? Debt and political restructuring. That's what we're headed for. So is this the time to be in the market? How likely is it that this is a bubble? I think I agree with Ray Dalio. I think it's pretty likely. Remember, it took 16 years to recover from the Great Depression. We had World War II and, a lot of pain. Now, compounding is a major key to long-term wealth growth. New clients often think they must take risks to grow their wealth, but that's just not true. The solution is not a hot new stock nor a new investment in another roller coaster market. Instead of taking loans from a commercial lender to buy bigger ticket items like cars or college or real estate or business equipment or vacations, our clients take loans from their personal cash value bank. They own the asset they buy, while their cash remains in their private bank, compounding every year for the rest of their life. And compounding is the key to a long-term fortune. Now, the mechanics of the policy loan, you basically make a loan request for up to 95% of your cash value. The insurance company uses your cash value as collateral but it does not take your money out of your cash value private bank. It leaves it in there and it continues to pay the interest rate and compound that value for the rest of your life, even though you've taken the loan. The insurance company gives you a loan from its general fund. Now, this is going to be an overview of how real estate developers can use the money in their cash value private bank to enhance their real estate business. We assume that instead of buying the property directly using your cash, that the real estate developer invested in their own private bank and then bought property with a loan from their private bank. And let's assume that the present value of the property is $100,000. The loan term is 30 years. The rental income is $1,000 over a 360-month or 36-year period. The market value then, after that 30 years, is going to be $100,000 with an annual increased value of 30% over 30 years, meaning that the market value is going to be $242,726. Positive cash flow from renting the property out at $1,000 a month for 360 months is $360,000. Now we have to minus the purchase price of $100,000, and we find that just buying and owning the property and managing it would produce $502,726 over 30 years. Now let's look what happens if you purchase the same property, $100,000, 30 years, $1,000 income, 360 months, with the same market value, but you purchased it with a cash value private bank loan. All of those first 5 things would remain the same, but what changes is the positive cash flow. Why is that? Because you're going to have to pay for the loan that you get from your cash value private bank. $360,000 from positive cash flow before is going to go $100,000 of present value. The annual rate of 5% we're saying is what you would pay in interest. That would be 360 months at $536.82 per year. That's what you would pay to borrow this money. Per month. You'd pay $536.82 per month to borrow this $100,000 from your own cash value private bank. Now, people sometimes at this point kind of throw hands up and say, I have to pay to borrow my own money? Well, remember, this isn't your money. This is a loan. They're paying you 4.5% to 5% in your cash value private bank, and that's compounding. So what you want to do is you want to pay off the interest on that loan so that you can earn the compounded interest. And we'll see this in another example in something we call altitude in just a minute and be more clear than this. But you're paying off the interest on the loan, you're keeping the property, you're making money on the property, and the interest that you're paying off keeps the debt from compounding, but you're compounding in your cash value private bank, then that's the insurance company is paying that. So basically, it's a net wash. You're not really paying for your money, you're net washing your money, but it's the money staying in the cash value private bank and compounding. So what does this do to the cash flow? Well, $1,000 a month is what you're going to get from renting out the property. The interest paid by you, $536.82, is subtracted, and that means that the new monthly income, free cash flow from renting out the property, is $463.18 over 360 months. That means $167,040, and that goes into this private cash flow, a positive cash flow line item here. Now, we have to figure out, now that we've paid for the interest on the loan, we have to figure out what the cash value compounded over those 30 years. And this is where it becomes clear that paying for the loan interest from your own cash value private bank was a very smart thing to do. Essentially, the $100,000 compounds at an annual rate of 4%. That's actually low It's going to be higher than that probably, but it fluctuates and we wanted to be conservative. So we said you pay 5% for the loan and you get 4% in your cash value private bank. That's more likely going to be a complete net wash. But over 30 years, that means that you've made $324,340 in your cash value private bank. We put that in, we subtract the $100,000 that you paid for the property, and we find out that you made $634,106 by buying the property, same property that you would have made $502,000 on. By buying it through a loan from your cash value private bank, you made $634,000, or a total of $131,380 more profit using a cash value private bank. And if you chose to put the $463.18 net monthly rental income into the cash value private bank every month, you would have made $790,178 on the same property. $287,445 more profit using a cash value private bank. Now, this is something that you can do too if you're not a real estate developer. You can start in a more simple way, and that is you can take a loan from your cash value private bank. This is a program we call arbitrage. This is something I do in the markets for myself. Capital borrowed and balanced, not the arbitrage portion, but the trading side of this. Capital borrowed and balanced, you borrowed $10,000 from your cash value private bank once, and that remains out for a 5-year period. You have $10,000 to work with over 5 years. You paid a 5% interest rate, which means every year you're going to have to pay $500 to keep this from compounding, this debt from compounding. That way you'll be able to arbitrage the $10,000 in your cash value private bank against the loan that you've taken out of it. Cash value growth at 4.5%, which is what we expect your bank to do, would bring you to $10,450 at the end of the first year. And after 5 years, that $10,000 will have compounded into $12,250 or $2,250 of actual profit. Now, the margin lever that you can use on the $10,000 once you get it out of your bank brings the money that you can actually use in the markets to $40,000. We can talk about this. We'll tell you how to do it. Just recognize that you can take the $10,000 that you borrowed from your bank and you can invest it as if it were $40,000. It's called notional funding. And now you've got $40,000 working in an outside investment. And this is a little bit shy of what I do in the marketplace, but I think that it's a realistic expectation. And that is that $40,000 comes to you in what I call an OM block, assets under management block. And look, we've talked about the sequence of returns. I don't compound my trading money because I don't want to deal with sequence of returns. I trade in a block. I allow the market to fluctuate up and down around that block, but it never goes down. So if I lose 10%, I lost $4,000, I would only have $36,000 worth of cash left, but it would still be trading at $40,000 worth of value. I know that these concepts sometimes can be confusing. I'd be happy to hold your hand and walk you through this and how this works. A per trade risk of 60.6% is $240 per trade. If I make money 68% of the time, I've got a much higher rate than that, but this is a reasonable rate. If you make money 68% of the time and you win $360 and you have 12 trades per year, then you get an annual profit of $2,938 on the $40,000. An annual loss of $922, you subtract them and net it out, you get $2,016, which is a return of 5% on the block. 5% on the $40,000. But because you're actually generating this revenue to feed back into the bank, which is a $10,000 loan, that 5.04% will make $2,016 per year for 5 years. After you take away the payment of the interest of $500, and after you pay 28% on the profit that you made, you end up after 5 years with $4,758 on a $10,000 amount. This $4,758 added to the arbitrage from the interest, the compounding inside your bank, comes up to $7,008. And that's 70% of the $10,000 you borrowed. This is arbitrage. Now, this arbitrage has a risk, because it's possible for you to lose money in the markets. I'm not suggesting that you do this arbitrage, but it's an arbitrage that can be done, and I can show you how to do it. And perhaps we could even work out something where we could build a little fund together if that's of interest to you. 70% on $10,000. So there are two different levels here. You can borrow $100,000, $200,000, $300,000 if your bank has it, and you can buy real estate with it. But you can borrow $10,000 and invest it prudently outside and make 70% on that $10,000 through two forms of arbitrage. The arbitrage between the growth in the cash value versus the loan that does not compound, and the ramping up of your money through a lever outside of the bank and using that in a very low risk portfolio to make even 5.04% a year, which is very achievable, and using that in the levered amount to ramp up your $10,000 as a 70% return on your investment over that 5-year period. And if you only ended up making 1.8%, 2%, which you could almost do in a treasury paper, if that's all you did, you would have a $92 profit after you paid off the $500,000 and paid or $500 per month and paid tax of 28%. You still would do 23% on your $10,000. So, again, compounding is a major key to long-term guaranteed wealth growth, and a cash value private bank will outperform the S&P over the long period. But it does so much more. It mitigates the risks that we face, the outliving wealth and income, the debt collapse, market volatility, lack of portfolio diversification, taxes and fees, fiat dollar reserve currency degradation, unfounded liabilities, abnormal correlation of assets during stress tests, unexpected loss of human life value, and physical disability requiring long-term care. Those benefits that we've talked about, the guaranteed return, tax-free, risk-free, exponential compounding, free and fully uncorrelated, multiplier effect, human life value protection, family protection, estate and legacy planning, asset maximization, the power to consume, instant permanent state creation, self-funding, liquidity for any reason without penalty, and fully protected from creditors, lawsuits, and bankruptcy, which is something we didn't talk about before. These are the benefits that mitigate these risks. And the next thing is, if you're interested, is to have a private meeting where we'll go over a general overview of risks, benefits, and structure. We'll get to know each other. We'll have a personal and specific asset analysis, liquidity, talk about risk buckets, risk concentrations, risk mitigation, intentional initial structures, and illustrations. And we'll do all of that at no cost or obligation. Then if you want to build a bank, we do that at no cost as well. We help you with the final design and structure, the application, the review, and acceptance. If you're accepted, which not everyone is, because these, again, are built on age and health, but if you're accepted You will have not had to pay anything out to us at all. Whatever we get, which is a relatively small amount, it costs a lot less to build a private bank than it does to put your money into a mutual fund, where somebody's taking a percentage, 1, 2, 3, 4% every year, as your assets grow. They take 1, 2, 3, 4 or more percent. That adds up to $95,000, $100,000 over 30 years. We get a very small, under $10,000 payment, most often under $5,000 payment, for providing all of this service for free. And that does not come out of your pocket. Anyway, that's it. Thank you so much for joining tonight's webinar. I hope you learned something. I look forward to talking to you and answering any questions that you have. And see you around. Thanks so much. Bye.